Hello, I'm Anthony Saglin-Benny, Chief Market Strategist at Ameriprise Financial. Although there have been some twists and turns along the way, the first three quarters of 2024 have generally been upbeat for both the markets and economy. To help you make sense of what could be in store for the last months of the year, I have a great panel of experts with me to share their insights and predictions. First, I'd like to introduce Russell Price, Chief Economist at Ameriprise, and Brian Erickson, Fixed Income Strategist at Ameriprise. Thank you both for joining me. Russ, I'm going to just jump right in. Federal Reserve in September finally cut interest rates, an event that most investors have long been waiting for. How low do you think interest rates could go in 2024? And should investors expect a big boost in economic activity from the first interest rate cut? Or will the effect be much more subdued?
Anthony, as you well know, the first interest rate cut that the Fed employed was for a half a percentage point, which was larger than what most forecasters were looking for. There are two more Fed policy meetings yet this year, and we could see a quarter point cut at each one of those, so long as inflation continues to subside. The economic impact of those cuts is likely to be somewhat muted, in our opinion, however, just as interest rate hikes were when the Fed was raising interest rates over the last 2.5 years. However, areas such as housing, construction, small business lending, commercial property financing should directly benefit as rates ease, thus offering a modest incremental boost to activity. Overall, we see the most likely path for the American economy over the intermediate term as one in which growth is a bit more modest, but still decidedly positive on the whole.
Hey, Russ, just leads me to a follow-up question for you. I mean, you mentioned interest rates probably shouldn't have a huge effect on the economy, and it is just one economic indicator that I think investors have been keeping an eye on. But what other measures of economic activity are you watching in the final months of the year?
Well, two areas that we're watching most closely, Anthony, are consumer spending and job growth. Both have been robust over the last 2 to 3 years, but of late they appear to be losing some steam. We don't expect either to fall into a sustained contraction, as consumers are still in pretty good financial shape overall. And as long as consumers continue to spend, companies should continue to hire, generally speaking. Rates of growth in these two areas, however, have been stronger than what can really be maintained over the long term. So a downshift to a more sustainable rate is a natural progression in our view. With that, Anthony, let me turn the conversation back to you and take a look at the financial market side of the equation. The stock market has performed well so far in 2024, as you mentioned, although there have been some bouts of volatility along the way. What drivers of stock prices are you watching over these final 3 months of the year, and is there a risk that stock prices could falter?
Yeah, I mean, I think investors are feeling pretty good about the stock market so far through the end of the third quarter. The S&P 500 is up around 20%. That is a very good year by historical standards so far. I think in the third quarter, we saw the stock rally broaden outside of big tech as kind of things that you've mentioned, right? Interest rates coming down with the Fed easing policy. Economic conditions are pretty supportive for profit growth. Investors moved ahead of that in the third quarter in anticipation that the economy would continue to grow and profit growth would continue to grow over the next couple quarters. Looking ahead, I think a lot of that soft landing narrative has been built into stock prices right now. So what we're watching in the fourth quarter is how does economic data come in versus expectations? How does profit growth come in versus expectations? Right now, investors expect profits to grow, interest rates to move lower, inflation to move lower, and the economy to continue to stay on a growth trend. If we see that in evidence in terms of the data in the fourth quarter, I think there's opportunities for the stock market to climb a little bit higher. Some of the things that could act as a tailwind, obviously we have an upcoming U.S. Presidential election. The markets have basically priced in divided government. So a result that leads to either one party control, either Democrats or Republicans, could create a little volatility for the market, around the election. But I don't think that should deter investors' overall portfolios and an overall positive outlook, given some of the strong fundamental backdrops that we should continue to see in the fourth quarter. So, as an investor, what do you do? Have a conversation with your financial advisor. There's a lot of investors that might have been caught off guard by this rally this year. This is a good time going into the final quarter of the year to sit down with your financial advisor, talk about your goals, talk about your plan, make sure your portfolio is consistent with those goals and plan. And if we do see a little volatility in the fourth quarter, talk with your financial advisor about strategies that may take advantage of that volatility. So you're set up going into the new year in a position that I think, from a portfolio standpoint and an economic standpoint, should be beneficial as we see stronger growth trends or growth trends that are coming down but still solid. Brian, I want to turn it to you and ask you a question about fixed income. We've talked about interest rate cuts. Obviously, they play a pretty big factor in the bond market and cash investments. So what could investors expect to see if we see further Fed rate cuts this year?
We've already seen fixed income price in some of these moves that the Fed has already taken and that the markets anticipate they'll take. When inflation was higher, we saw fixed income investments, higher quality fixed income investments particularly, were yielding 5 to 6%. Today, that's 4 to 5%. Still a solid yield, and particularly a solid yield in the context of the inflation that we're kind of left with here after the Fed's policy has taken effect. So when we're looking at it, we think this is still an attractive time to engage in the fixed income market, and particularly in those higher quality segments like core bond that includes govies and investment grade corporates. Now, on the front end of the curve, with cash investments, as you mentioned, that's a little bit different picture for cash investments. We've seen cash investment yields drop by almost a full percentage point over the course of the last couple of months. We anticipate that that every Fed policy meeting that there's a cut, we'll see another cut in the kind of yield that you're able to get in cash investment yield. So, that's just a kind of a sinking lily pad, as an example of really what that would look like. Whereas fixed income, you can actually term out and actually earn that yield for a longer period of time. Cash investment yields are really just at the really subject to what the Fed's decisions are going to be. So in a lot of ways, like the market and the portfolio you had in 2021 and 2022, the things that were attractive and that were part of that portfolio, maybe like a floating rate bond fund, for example, ultimately that's not necessarily the investment that would be top of mind today, given the fact that the Fed's lowering its policy rate, and that's impacting that type of investment. So what is more attractive is the higher quality, more yieldy, more solid yield from higher quality investments today.
Thanks for that, Brian. Really insightful perspective, some great takeaways for investors as we wrap up 2024. With that, thank you to my colleagues Russ and Brian for joining this conversation, and thank you to our clients and other viewers for watching. If you have questions about current market conditions or would like to receive additional timely insights from the Ameriprise Investment Research Group, please contact your Ameriprise financial advisor.